Let me save you from making the same mistake half the internet makes every tax season. Acting like taxes are this spooky wizard dungeon nobody can understand, while the government is standing there like, we literally wrote the rules down. And I'm here to tell you, if you're not paying attention to the 2026 tax landscape, you could be leaving real money on the table like it offended you personally. Today, we're talking about the tax moves, deductions, and legal little strategy pockets people keep calling loopholes, even though half of them are really just the IRS rewarding people who actually read directions. Also, tiny disclaimer, I am not a financial advisor. I am a cute avatar with excellent lighting, strong opinions, and a suspicious amount of tax enthusiasm. So use this video to get informed, then run your actual situation by a qualified pro. Here's the issue. Tax law does not sit still. It changes, sunsets, gets renamed, gets expanded, gets phased out, and then social media keeps recycling old advice like it found a stale French fry under the car seat and called it lunch. That's how people miss money. They hear one viral tip, assume it still works, and then structure their whole year around a strategy that already packed its bags and left town. And 2026 matters because this is where a lot of people get sloppy. Some provisions got reshuffled, some limits moved, some planning windows are still open. Some internet-famous tax breaks are already on life support or gone. So the question is not just, what are the best tax loopholes? The better question is, which moves are actually useful now? Which ones are changing? And which ones are fake smart advice dressed up in confidence? That's the game. Not random hacks, not tax cosplay, timing, eligibility, and knowing which doors are still unlocked. First up, one of the cleanest tax plays for regular people is still the HSA, if you qualify. This matters because a lot of young workers ignore it like it's broccoli with paperwork. Bad move. An HSA can give you a tax deduction for contributions, and in 2026, the limits are higher again. That means if you're eligible, this is one of the easiest ways to lower taxable income without needing some rich uncle trust fund nonsense. And here's where it gets more interesting. Starting in 2026, certain direct primary care arrangements can work with HSA eligibility in situations where that used to be a mess. So for some people, the rules just got friendlier. That does not mean everybody qualifies. It means the door got wider, not that the building disappeared. Second, if you own a business or you're building one, equipment timing still matters. I need people to stop buying random junk in December and calling it tax strategy. That is not strategy. That is emotional support shopping with receipts. But legitimate business purchases that actually qualify can change your deduction picture in a major way through Section 179 and bonus depreciation rules. So yes, the timing of when you place real business property into service can seriously matter. Pause. Quick tax wellness check. If you only started caring about deductions when you realized vibes are not deductible, blink twice. If you bought a $9 latte while ignoring your HSA, Tobin is judging you right now from across the room, respectfully, with dramatic anime disappointment. Now, here's the part people need to hear. Not every so-called 2026 loophole is actually a 2026 loophole. Example, the QBI deduction became one of those magical phrases people throw around to sound sophisticated at brunch, but the IRS page still describes it as applying to eligible tax years ending on or before December 31st, 2025. So if somebody is selling you a secret 2026 QBI trick, like they found buried treasure behind a vape shop, maybe put the wallet away. That's why tax planning is not just about chasing deductions. It's about verifying whether the move is still alive. Some breaks are ongoing, some got expanded, some expired. Some are only powerful if you act before income jumps, before year end, or before paperwork gets messy. The clock matters. The filing status matters. The business structure matters. The details matter. So the real lesson here is simple. The biggest tax mistake in 2026 is not knowing every loophole. It's assuming the loudest advice online is current, accurate, and built for your situation. For some people, the win is an HSA. For others, it's retirement planning. For business owners, it may be how deductions are timed and documented. And for everybody, the first step is separating legal strategy from recycled nonsense wearing a suit. And we're not done, because once you understand which tax moves are real, the next question is even more important. Which ones are worth acting on first, and which ones are just shiny distractions with accountant cosplay energy? Now, let's talk about one of the most misunderstood moves in tax planning, because every year somebody hears one sentence about it, mangles it beyond recognition, and then starts talking like they unlocked the financial matrix. I'm talking about the Roth conversion. A Roth conversion is not free money. It is not a coupon code. It is not some magical tunnel where taxes disappear wearing sunglasses. What it really is a timing decision. You move money from a traditional bucket into a Roth bucket. And if that money has not already been taxed, you may owe tax on the conversion now, so you can potentially get better long-term treatment later. That matters in years where your income is temporarily lower, your tax bracket is friendlier, or you're early in your career and future income could be much higher. In other words, sometimes paying some tax now on purpose is smarter than getting ambushed by more tax later when your money has bulked up and returned with abs. And while we're in the retirement lane, this is where younger viewers can quietly build a huge edge while everybody else is busy arguing online about whether investing is worth it with $87. The contribution limits moved again for 2026, which means the tax shelters are still there for people who actually use them. Traditional contributions can help some people now. Roth contributions can help some people later. The point is not to blindly copy somebody on the internet. The point is to understand which bucket helps your actual situation. Because tax strategy is not just about what you deduct. It is also about where your money lives, when it gets taxed, and how many future headaches you can prevent while you're still young enough to be dangerous in a good way. Next, tax loss harvesting. Fancy phrase, very normal concept. If you have investments with losses, those losses may help offset gains. And if losses go beyond gains, there are rules that can allow a limited amount to reduce other income, with extra losses often carrying forward into future years. This is why serious investors do not just stare at the green numbers and throw confetti. They also pay attention to the red numbers and ask, can this pain at least be useful? That said, this is where people get too cute and trip over their own shoelaces. Not every loss helps you. Selling your car for less than you paid is not some genius deduction. Watching your couch lose value is not tax planning. That is just furniture aging like furniture. And this is where the wash sale rule comes in and ruins the lazy version of the plan. You cannot usually sell a stock at a loss, turn around, buy basically the same thing right back around the same time, and then act shocked when the IRS says, "Cute try." Timing matters. What you repurchase matters. Documentation matters. This is one of those areas where sloppy people create fake wins for themselves in spreadsheets and then get humbled by reality later. See the pattern? The money is not always in some dramatic loophole hiding behind a secret bookshelf. Sometimes the savings come from using the normal rules better than average people do. That's the part social media hates because it is less glamorous. There's no dragon, no hidden vault, no billionaire monk whispering tax secrets from a mountain. Just people who understand timing, account type, income level, and paperwork better than the crowd. And that is exactly why windows close on people. Not because the opportunity was impossible, because they waited until tax season to care about something that should have been planned while the year was still alive. So now we've got two big truths on the table. First, some of the best tax moves are timing moves, not trick moves. Second, a strategy can be technically real and still useless if you apply it at the wrong moment. Which brings us to the next layer, the part people really mess up. Business write-offs, record keeping, and the dangerous little fantasy that if I bought it, it must be deductible. Now we arrive at the part of the tax conversation where common sense goes out for cigarettes and never comes back. Business write-offs. Because for some reason, the second people start a side hustle, a tiny goblin appears in their brain and whispers, "What if everything is deductible?" No, calm down, Turbo. The IRS is not running a clearance sale on your entire lifestyle. The first filter is simple. A business expense generally needs to be ordinary and necessary. That means it should make sense for the kind of work you actually do, and it should be helpful and appropriate for the business. Helpful, appropriate, not, "I convinced myself this gaming chair is a spiritual tax event." If you run a design business, software may make sense. If you drive for work, certain vehicle costs may make sense. If you buy something mainly because you wanted it anyway, and then sprinkle the phrase content creation on top like parsley, that does not automatically make it deductible. Now, let's talk home office, because this one gets abused so hard, it probably needs therapy. A home office deduction is not, "I answered one email at the kitchen table." The general rule is that a specific area of the home needs to be used exclusively and regularly for the business. Exclusively means business only. Regularly means this is a real, ongoing work area, not a once-a-month laptop cameo between cereal bowls. There is also a simplified method that generally uses $5 per square foot up to 300 square feet for qualified business use. And even when the home office deduction is real, that does not mean the whole house suddenly joins the payroll. Some home expenses get allocated, some have limits, some get carried over depending on the math. This is where grown-up record keeping comes in, because once the deduction becomes real, the receipts, square footage, and method you used start mattering a lot more than whatever your cousin's barber said on a podcast clip. Next, vehicles. People love to blur the line between business driving and just going places. Driving from home to your regular workplace is generally commuting, and commuting is usually not deductible. Making a business call in the car does not magically baptize the trip into a deduction. The IRS is basically saying, "Nice try, still commuting." Now, if the driving is actually business related, there are different ways to calculate it, including the standard mileage method in qualifying situations, or actual expenses in others. But this is not a buffet where you pile both methods onto the same plate because you're feeling ambitious. Travel and meals are another area where people get sloppy and suddenly become historians of events that never happened. If you're traveling away from home on business, records matter, logs matter, documentation matters. And business meals are generally not a full free-for-all either. The deduction is generally limited to 50% of unreimbursed cost, which means that I bought lunch and talked about business for 6 seconds is not exactly the tax masterpiece some people think it is. And this is the deeper point. A lot of tax savings do not disappear because the rule was bad. They disappear because the owner was lazy with proof. They had the expense, but not the log. They made the trip, but not the documentation. They used the room, but not exclusively. They drove the miles, but not with a record that holds up. People want sexy loopholes, but the real edge is often boring competence wearing glasses. That's the move. Not pretending everything counts. Proving what actually counts. So now we've cleaned up the biggest fantasy in the room, which is the idea that deductions are just vibes with receipts attached. They're not. They're rules. And once you understand that, the final step is the one that really separates people who save money from people who merely talk about saving money. Planning before year end, not panicking after the fact. This is where the whole thing either becomes a strategy or stays a cute little fantasy. Year-end planning, because a shocking number of people treat taxes like a weather event. They look up in April, get soaked, and then act stunned that clouds were forming the whole time. No. The people who save the most money usually do not start in panic mode. They start before the clock turns ugly. That means looking at your income before the year ends, looking at your deductions before the year ends, looking at gains, losses, contributions, purchases, and business records before the year ends. Notice the pattern here. Before, not after you've already created the mess and now you're whispering to your calculator like it can forgive sins. And for self-employed people especially, this matters even more because taxes are often not just one dramatic springtime jump scare. The IRS generally expects estimated taxes to be handled during the year, not treated like a surprise boss battle at the end. This is also where people need to understand something boring but powerful. Not every tax move has the exact same deadline. Some contribution windows can stretch into filing season. Some elections, setups, purchases, or documentation choices need to happen earlier. Some things still help if you act by the return deadline. Some absolutely do not care about your last-minute personal growth arc. That is why I'll figure it out at tax time is not a plan. That is a decorative sentence, a tax-themed pillow. Strategy means knowing which door closes on December 31st, which one closes when you file, and which one never opens unless you documented it correctly in the first place. So let's say Tobin Atlas had a decent year. He made money. He did some freelance work. He had some investment gains. He had a few losses. He bought some real business tools. He also almost tried to deduct 3 suspicious purchases that absolutely would have gotten him spiritually slapped by common sense. The smart version of Tobin does not wait until April to become reflective. He checks his numbers while the year is still breathing. He looks at whether a contribution still makes sense. He looks at whether losses should be harvested carefully. He looks at whether business expenses are documented. He checks whether he needs to clean up estimated payments, tighten records, or ask a real professional for help while there is still time to do something useful. And that right there is the difference between people who use the tax code and people who just complain about it. One group plans while options still exist. The other group discovers the rules after the doors have closed, then gets mad at math like math betrayed them. That's the real closing window in 2026. Not just one mystical loophole disappearing in a puff of smoke. It is the shrinking amount of time you have to make smart, legal, documented choices before your options get narrower, your paperwork gets uglier, and your flexibility starts leaving the building in sensible shoes. So here's the summary. The strongest tax moves are usually not cartoon loopholes. They are timing moves, account moves, documentation moves, and planning moves. HSA strategy if you qualify. Retirement account strategy that fits your bracket. Losses handled intelligently. Business deductions handled honestly. Records handled like an adult. That is how you keep more of your money without drifting into nonsense. And once again, I am not a financial advisor. I am a cute avatar with good posture and a deep distrust of lazy bookkeeping. So take the ideas, verify what applies to you, and run the real decisions by a qualified tax pro. If this helped you, hit like, subscribe, and drop your biggest tax question in the comments. And check out the ebooks and check out our many financial calculators and other resources, links below. Because walking into tax season with no tools is like trying to open a vault with a spoon. Technically, you are doing something. It is just not the right something.